So there's been a lot of talk recently about inflation and what this means for the U.S. economy, and in particular, been hearing more about the possibility for a wage price spiral in the U.S. This is something that dates back to the 1970s when there was pretty significant inflation that then turned into pretty significant wage increases, and people saw this feedback take hold, and it was really difficult for the U.S. to deal with it. So the question is, are we in a place right now where we should be worried about a wage price spiral taking hold in the U.S.? So let's talk about the data a little bit. So the recent numbers that we've had from inflation have obviously been quite high. So over 7% in 2021 for the U.S. economy as a whole. And interestingly, we've also seen wages tick up quite a bit. If we look at the U.S. government's employment cost index, which is a measure of wages and salaries and other costs to employers, we see that it actually increased in 2021 at a rate of 5%. And that's up quite a bit. So that's a number that's well above the 2 to 3% range that we've seen for a long time. So should we be worried about the fact that both wages and inflation are going up at the same time? Well, that depends, right? It depends on whether there's sort of temporary shocks that are leading to this, such as the supply chain issues or a shortage of labor from people exiting the labor force because of COVID. So how do we try to unpack whether this is something that's going to lead to a spiral or whether it's just a transitory issue? Well, there's some preconditions that we need for a wage price spiral to take hold. One is that, in fact, there is a shortage of labor out there, that workers are able to command higher wages. Those higher wages will then feed into the costs of businesses, who are then forced to increase prices, which is, of course, inflation. So do we see a shortage of labor? Well, last year was one of the best years ever for job creation in the U.S. And in fact, the unemployment rate right now is low, and it's probably at or below what most people think is the equilibrium rate of unemployment. So it's around 4%. And if we think about 4% as being a labor shortage, then that's going to give laborers the opportunity to command higher wages, and that leads into the costs of producers, of course. Another important condition is that if workers are actually able to command those higher wages, they're going to go out and spend them, right? If people just save the money, then that wouldn't necessarily lead to higher demand, and so there wouldn't be the ability for producers to raise prices on goods, and so you might just see the profits of companies shrink due to the higher wages. But in fact, there's a lot of evidence that consumers are out there spending. There's been a pretty significant growth in retail sales. We just got the January retail sales data, which was a barn burner. Much higher growth in demand, even in the face of the really severe Omicron infections that were infecting over 800,000 people a day on average. So the fact that we're seeing this really strong consumer demand, what looks to be accelerating wages in the U.S. makes us really worried that there could be a wage price spiral taking hold. But there's another important condition as well, and this one gives us a bit more comfort, and that is we need expectations for people in the economy, and especially consumers in the economy, to reflect that there will be higher inflation in the future. And here we see that what people call inflation expectations are well anchored. And so while inflation was 7% last year, looking forward, consumers don't think it's going to stay 7%. In fact, they think that within 3 years to 5 years or so, it'll be back down to a much more reasonable 3% level. And if we look at investors who actually put money on the line, what they think inflation is going to be, it's an even lower number. We can see those expectations through the Federal Reserve statistics, looking at the difference in yields between inflation index bonds and regular bonds. And they actually say that if we look out a few years into the future, inflation is going to be the same as it has been for the last decade, right around 2% or so. So depending on who you believe, depending on what statistics you look at, you might be concerned about a wage price spiral taking hold, but certainly capital markets don't seem worried about it, and the typical household consumers don't seem concerned about it either. So hopefully that's been an interesting and informative discussion on the wage price spiral. If you'd like to learn more about it, please see our more detailed analysis and write-up on our data commentary page.